The transferee corporation also has tax consequences to a 351 transaction. First, no gain or loss will be recognized when its stock is issued in exchange for property or services, whether or not Section 351 is satisfied. No gain or loss will be recognized when it's issuing debt for property or services. Gain but not loss will be recognized if a corporation transfers appreciated property as part of a 351 exchange. We'll treat the property like it was sold for fair market value prior to the transfer. In a taxable transaction, so one where 351 does not apply, the basis of any property received is going to equal the fair market value. But if Section 351 applies and defers taxation, the basis in the transferee has in the property it receives. So remember, in the situations we were talking about, the transferee is the corporation. So they receive property, in exchange they issue stock. So the corporate's basis in the property it receives is as follows. It starts with the transferor's adjusted basis in property transferred to the corporation. To that, we add any gain recognized by the transferor, and we reduce for lost property if applicable. That's going to equal the transferee corporation's basis in the property. Now, remember, we did not recognize loss as the transferor, but as the transferee, we're going to reduce for lost property if applicable. And then the holding period. The transferee is going to receive assets in exchange for stock. The assets they receive, the holding period will be determined by whether or not 351 applies. If 351 applies, the holding period is going to include the holding period of the transferor. If a transferor transfers property with a built-in loss, Section 362E2 requires the basis of the transferee to be no more than the basis of those assets to the transferor. Any reduction is accomplished by reducing the basis of each property according to its relative loss. In this case, the holding period begins the day after the exchange if the basis of all assets are reduced. And the shareholder may elect to reduce the basis of his or her shares rather than the corporate basis of the assets. So this prevents a double built-in loss. If we had a double built-in loss, the shares would be overvalued and the assets would be overvalued in the corporation's hands. This prevents that. Section 362 prevents that, and it requires a reduction of the basis in the corporation's hands by the amount of that loss, that built-in loss. And in the alternative, the shareholder can elect to reduce the basis of his or her shares instead of the corporation reducing the basis of its assets.